Welcome to Get Rich Education. I'm your host, Keith Weinhold. Real estate versus stocks. What's better? Which entails more risk? Which has more opaque fees? What about rates of return? And why would a CFP be on the show today? I tell you which stocks I own, if any, all today on Get Rich Education. Finally, with Total Control Financial, get checkbook control of your existing 401k and IRA funds to invest in real estate. Yes, you can move your retirement money into your own checking account, but you must avoid the little-known tax that you'll get hammered with in a self-directed IRA. Instead, start your QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to Get Rich Education. I'm your host, Keith Weinhold, bringing you that weekly dose of abundance because I've got to, since the scarcity mentality is abundant and the abundance mentality is scarce. Real estate versus stocks. Well, a lot of people pick real estate for the residual income that it produces. If you accumulate enough of that, you've got financial freedom. How much does your stock pay you? Well, your stock, in fact, might pay you if it's a dividend-producing stock, but it's just not the same. Now, why do I say this? Well, first of all, a dividend is a payout from part of a company's earnings to a class of shareholder. Now, when we talk about trying to generate income from stocks in the form of dividends, well, dividend-paying stocks, they tend to be those older, more established companies. And because they're often older companies, they tend to have less year-over-year share price growth. They're generally the opposite of a young green shoot. I'm talking about companies like Coca-Cola or Kimberly-Clark or Lowe's Home Improvement Store that pay a 2% or 3% dividend yield. Now, it's important for you to know that the dividend yield, that is already included in a stock's total rate of return. So, for example, just say Coca-Cola had a 6% return and a 3% dividend. It is not 6 plus 3 equals 9%. That is not what you get. Instead, a 6% total return with the 3% dividend, that means that 3% came from capital growth and 3% from the dividend. That's different from real estate, where you might have a 20% gain from leverage appreciation, plus, yes, on top of that 20%, another 7% cash-on-cash return, plus, of course, amortization, tax benefits, and inflation profiting. Another way to say this is that if you're calculating a stock's total return, say in the trailing past year, all you do is you take the change in share price and you add it to the dividend if there is one. That's it. Now, some of the most well-known publicly traded companies offer DRIP programs, DRIP. That stands for Dividend Reinvestment Program. That means rather than you, the investor, taking the dividend as cash, instead it's automatically reinvested right back into more of that stock. Now, some investors don't even realize that they have the option of a dividend payout rather than the DRIP. So a DRIP is basically recirculating a cash distribution right back into the stock that you instead could take as cash. A lot of times, it's older retired investors that gravitate toward dividend-paying stocks to give them a little retirement income. Some dividend yields are as low as 1 or 1.5%, and some of these dividend-paying companies might be more than 100 years old, like Chevron Corporation, or have even been around since the 1800s like Procter & Gamble. Today's guest and I are going to discuss real estate versus stocks. He is a CFP, and you probably know that a certified financial planner is not a job title, it's a professional designation. It's a certification mark awarded from a board, and CFPs are usually in that stock world. But today's guest is not a conventional CFP, and as you'll see, he can speak to both sides, real estate and stocks. We're going to discuss how conventional stock, bond, mutual fund, and ETF advisors get paid. And now there's nothing wrong with getting paid, of course. Businesses that provide value have income, just like real estate companies. When he works with clients, well, what do they ask him? And what do they already know? And what do they assume that's just not so? Let's meet today's guest. Today's guest is a certified financial planner who has worked in financial services for over 14 years, and this includes time within the wealth management division of a large bank and as a local registered investment advisor, and most recently in the capacity of a financial coach. And in the midst of his journey, he became a real estate investor and an advocate for early financial independence. What I like about today's guest, he can really speak uniquely to the worlds of both conventional financial planning and real estate investing and understand both of those worlds and how they overlap and where they differ. Joining us from Pittsburgh, Pennsylvania today, welcome to Get Rich Education, Brent Sutherland.
Keith, thank you for that wonderful intro. It's good to be back. I look forward to digging into some topics with you here today.
There are restrictions placed on conventional advisors speaking about real estate investing with their clients. They're not motivated to talk about it at all. Tell us more about that.
This is an important topic to address because honestly, this is the question I hear probably most often.
Yeah.
Is that people say, I know someone who invests in real estate. I understand that it can be a powerful wealth building tool. But if that's really the case, why isn't it that my financial advisor doesn't mention it to me? Or why don't I hear this from other financial planners that have on their own podcasts or anything else? Really, it boils down to three main points here, and we'll dig into each one just so your audience has a better understanding of why this is the case. First point, and probably the most dominant point of why advisors won't talk to people about real estate, is that there's just conflicts of interest with the compensation structure.
Right.
Flat out. Most advisors, they get paid one of two ways. The more old school way that's kind of getting phased out is that they get paid off commission. So they're either selling a product that they get paid in return for selling that product to a client. Most often nowadays, this is in form of an insurance-related product. So this is a licensed insurance product that the advisor will sell to the client. And then in turn, they get a commission, sometimes as high as 8% off the value of that type of insurance product in return for selling that to the client. Also, in the more dominant, I think, way that advisors are getting paid today is through the assets under management model. For short, it's called AUM model. In essence, what that is just in return for giving some assets to an advisor to manage, and maybe it's a pool of $1 million. They'll put this into a portfolio. They'll manage that for you, and it's in the form of stocks, bonds, some REITs, some other things probably mixed in. But they'll charge a percentage of the total assets in return for their services. So on $1 million, 1% roughly on average, they're going to pay about $10,000 a year to manage that for you. Now, in both of these situations, you probably understood that I didn't say anything about real estate. And that's because advisors aren't licensed to sell real estate products. So the odds of them recommending you go into real estate, if you're talking to an advisor, are very, very slim because they don't get paid in return for making that recommendation. So you have to kind of keep that in the back of your mind that there's just that conflict of interest monetarily that will prevent them from recommending you pursue or go into real estate with your money.
Yeah, it's just not in their own self-interest.
Absolutely not.
So under the model that's more favorable today, the AUM, the assets under management, who pays that advisor their 1% fee?
That is usually in the form of the clients in their accounts. So let's just say that the advisor is managing the money, the $1 million portfolio that we just mentioned. That money gets deducted probably on a quarterly basis, sometimes monthly, from the account. And it's without the client really seeing. They're not cutting a check for that, which makes it kind of easier for the advisor to charge that fee. At the end of the day, they'll just see the imbalance of their accounts and they won't see that outgoing fee to the advisor unless they're actually looking at their monthly statements.
So that is a fee for doing business, and clients should get used to paying for a service. But however, they're not motivated to show you anything else other than the securities and the equities that they offer. So the second of three ways that you talked about that conventional advisors don't have any incentive to talk about real estate investing is just a general lack of education about it.
That's completely correct. Because I'm really just a child of the traditional financial educational system. And so I can tell you that going through undergraduate work, going through the post-undergrad where I was getting my education curriculum for getting my certified financial planning designation, nowhere along that journey did I ever come across educational components that talked on how to invest properly in physical real estate. There was a lot of mention of real estate investment trusts, which are REITs for short, but nowhere along the lines did it talk about investing in real estate. So from a general standpoint, if you want to educate yourself on the subject as an advisor, you're going to have to take on that task independently of any education you got through the formal system. And really that's set up that way just because the regulatory bodies have systems in place that will make sure that advisors are only talking about licensed products. That goes into the third point there is that if advisors do talk about non-licensed products, there are these regulatory bodies that oversee what advisors are doing to make sure there's not any blatant wrongdoing that's going on in the communities, which is needed because there have been some incidents with the different advisors in the financial services industry, but they want to make sure they can regulate what's happening within this world. And so they'll regulate what advisors are doing, and their advisors are only supposed to be talking about licensed products. Licensed products would not include physical real estate. It would include products such as stocks, bonds, insurance products, and what have you. Advisors will tend to shy away from talking about real estate as a whole just because they're afraid of potential implications if something bad were to happen with a client that they gave a recommendation on that put their money into real estate.
Right. They're not going to say, hey, did you ever think about going and buying this apartment building over there on the other side of town? Because that would go outside of any regulatory oversight jurisdiction.
Absolutely. So these are three pretty big hurdles. You're talking about conflicts of interest when it comes to compensation. You're talking about lack of education. And you're talking about regulatory hurdles that keep these advisors from talking about real estate. When you put all three of these big hurdles in front of someone, yeah, chances are they're going to shy away from this completely. And you're not going to have that conversation with anyone who's licensed talking to you about investing in real estate.
Let's talk more about that first one, the fees. I want to know, what do you think? Is it easier for fees to be hidden in the direct real estate investing world or in the world of a client going ahead and investing in a basket of stocks, bonds, and mutual funds? Now, there are some fees that might exist that get hidden somewhat in real estate if you don't look out. For example, you might have a property manager marking up some materials. Where do you think it's easier for fees to be hidden?
Now, hands down, it's easier to be hidden with the financial planning industry. When you're doing the assets under management model, as I mentioned, that fee gets deducted. You don't feel it because you're not cutting a check each month to pay that advisor. It gets automatically deducted from your account. So what you see, you don't really feel as much as when you do in real estate, cut that check because it's very transactional with real estate, right? You buy a property, you're going to cut a check for that property for the down payment and all associated fees included for the transaction. You see that check, you're cutting that check, you feel that check way more than you're going to by just an ongoing management fee that's in the background working that you don't see. You don't have to go in and log into an account and make sure you're paying that monthly. It's just automatically deducted. So from an emotional standpoint, there's definitely more by paying that fee whenever you're dishing it out through transactional occurrences with real estate.
Now, Brent, I know you've said before, just flat out, well, the stock market really won't make you wealthy. But before we go on with that, I need to know, since you are currently a certified financial planner, doesn't the conventional financial planning industry just go kill you for discussing these sorts of things and opening it all up and showing both sides?
It definitely makes for interesting conversations. And I'm in both worlds, right? So I do have conversations with real estate investing cohorts, and I have conversations with all my colleagues from the financial planning industry. And these two groups, they butt heads quite a bit. I think there's just a frame of mind whenever you're in the financial planning world that stocks, bonds, that's the only way to go. And for most people, it kind of is. Some people don't want to get hands-on with their investments. I get that. But if you're looking at the potential that can be had from investing in real estate, there's just no comparison if you're doing it right. The reason why I kind of bring up the stock market not making you wealthy is that I think what there is a misunderstanding and this goes back to the lack of education with most advisors,
Right.
is that they'll look at the price appreciation of real estate versus the price appreciation of the stock market as a whole.
Exactly.
And if you look at those two numbers, and that doesn't take into consideration everything else that's included with real estate, on paper, it can look like the stock market is the more lucrative buy because over the course of time, 8 to 10% a year annualized over the past 80 to 100 years, that looks like a pretty attractive return. But with real estate, comparing just the appreciation of the property, that's only one factor. And as you lay out frequently on the show, there's 5 different ways to make money in real estate. And you add that all together, now we're talking about returns of 30, 40%. That just pales, the stock market just pales in comparison to those types of returns. So lack of education. I like educating when I'm in those groups with the traditional financial planning cohorts. I like training them and educating them on all the different ways to make money with real estate. And quite honestly, after they hear the numbers, they kind of come on board, not fully, but I've started pulling some of those colleagues more in this direction over the course of time.
I must admit, I used to be uninformed. Shortly after coming out of college, I thought the same way for a few years. Well, stocks give a return of about 10%, and you can be almost completely hands-off. Real estate only returns 5 to 6%, and it's messy, and you got to deal with tenants and properties and maintenance. Are you kidding me? Stocks are clearly the place to be. But yeah, once you learn more, you learn the whole story with the 5 ways real estate simultaneously pays you, the 5 to 6% long-term appreciation only being one of those 5. You find that returns of 30 and 40% in real estate are common, and that's without any inordinate risk.
Absolutely. Yeah, the numbers just go in the favor of real estate.
Now, you've said that true wealth really is not generated through the stock market. In your experience, both as an investor and a financial coach, where do you see wealth being generated?
And I will say, just as kind of a preamble here, I'm not saying that the stock market can't be a form of wealth building, but saving into 10% of your money into a 401k over time is quite a slow churn. I just think that in order to become wealthy, you have to really accelerate that velocity of wealth growth. And where I see people become more wealthy is in wealth creation as opposed to wealth building. And the 2 areas I see wealth creation happen is really in businesses that they're starting or in real estate. And what I mean by wealth creation is that you're taking something, either you're taking an idea or taking an existing business, or you're taking property, a real estate property that you have, and you're improving it. And then you're creating more value. You're creating more equity. That's the way to kind of supercharge your path to wealth as opposed to just that slow churn of wealth building. So that's really what I mean by becoming wealthy versus just the slow churn in the stock market of saving a certain percentage over time. You're building these chunks of wealth that get you there much more quickly.
Right. There is a distinct difference between creating wealth and wealth preservation, where most people make sacrifices just so they can retire with a secure retirement at age 65. Maybe that's more of a preservation strategy than it is true wealth creation and getting an income stream when you're young enough to actually enjoy it. I know earlier you had talked about this chart from Visual Capitalist, and I really like Visual Capitalist. You can check them out at visualcapitalist.com because they really have these bright, colorful charts that bring a lot of these things to life. And that was the composition of wealth and just how that differs between the middle income and the top 1%. Tell us about that.
I think this chart does a great job of showing, how the middle income have their assets tied up, and the predominant portion of their wealth is in their principal residence.
Right.
It's not even close. And you've mentioned this on your podcast many a times, that when you have this money tied up into one particular property, and especially into your principal residence, that kind of becomes dead equity. You can't really put that money to work. It's earning a 0% rate of return. So this is not going to get you wealthy if you're having over 60% of your net worth tied up into a property that you're living in. Now, compare this to, on this chart, it lays this out, the wealthy and the percentage of their net worth, the majority of that is tied up into business equity interests and other real estate. Those 2 factors alone, just showing how the middle income have their net worth tied up and how the rich have their net worth tied up, should tell you something, that the true wealth is created through business interest and through real estate.
I think home equity really correlates with safety for people, and home equity is better than nothing. And the epiphany that home equity's rate of return is always zero is just a real breakthrough for a lot of people. Wealth is created by going ahead and breaking off a piece of your equity and putting it into a cash producing asset, or developing some intellectual property, or taking your idea and making it real and putting it on Kickstarter, or doing something that's going to build substantial income streams and not just accumulate equity. You're listening to Get Rich Education. We're talking with Intellivest's Brent Sutherland. More when we come back. I'm your host, Keith Weinhold.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
This is author Kristen Tate. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Brent Sutherland of Intellivest. This is different. We're talking with a certified financial planner. Why would I have anything to do with talking to a certified financial planner on this show? Well, I think you're finding out today because Brent does not approach things conventionally. He's got this holistic view because he is a real estate investor himself. Brent, you deal with clients, being the financial coach that you are. And a lot of times I think it comes down to a client never really asking the right question, because mainstream society, they're really trained to ask a question like, now, should I be putting my money in the target retirement date 2040 fund or the target retirement date 2050 fund? Or maybe asking a question like, well, now how can I bump up my retirement contribution amount? Because if I have any extra dollars, I should be putting them into retirement. Instead, I think a better question, a more holistic question that most people don't even know to ask because they don't even know that cash flow is a viable thing, is perhaps a question just simply like, now, how can I have both a better short-term future for myself and long-term future for myself rather than just deferring everything from decades? Or maybe asking a better question like, now, what is my real ROI, not just in the fund that I'm investing in, but my actual return, not the fund I'm investing in's return, but my return after I factor in things like inflation and emotion and taxes and fees and volatility. What's my return? So are people even asking the right question in the first place?
I don't think so, Keith. Honestly, most people come in not knowing what questions to ask. I think they tend to approach their conversations with their advisor in relation to all about their retirement planning.
Right.
And the question that I tend to ask clients is, what do you want the next 5 years to look like of your life? What do you want the next 10 years to look like of your life? And let's go from there first. Let's not talk about 20, 30 years down the road. Let's make sure that we square away what your situation looks like on the horizon so that you can live a better life now. And let's find ways to get creative with your money to make that happen.
Now, do people have a hard time opening up? For example, when you ask them that question, what would you like your next 5 years to look like? A lot of times I'm imagining people are thinking small and they're thinking things like, well, I plan to get a 10% raise and that way I could contribute 5% more to my retirement account. And that's the kind of answer that they're going to give you.
Absolutely. It rarely goes back to their career. If they're unhappy with their job, if they want to change in their life, it's always about, maybe I need to just make more money, save more money so I can get to that end goal more quickly. But if we can change the conversation about potentially investing in assets that can generate some money to replace some of your income, so maybe you can go into a career that might not pay as much, but you'll be much happier with now. Let's have those conversations and see how we can move that money around to get it set up in a position where you can get to that point. So those are just things that can get kind of topped on their head. But what I see most often is I'm the one that tends to have to ask questions to people just because they tend to go in with the mindset of deprivation more so than they do of living for abundance now. I don't know if it's just a societal norm that we feel like we have to suffer presently in order to have, the golden parachute down the road. But I think there's a lot of ways to get creative with money, especially with real estate, where you can improve your life now as opposed to waiting for tomorrow.
But you're a coach, not a mentor. Do some people feel offended when you try to find a careful way to say, like, hey, dude, it isn't all about frugality and contracting. Like, did you ever think about growing and live how you really want to live in the near term? How do you do that?
Well, it can be a mindset shift. So you're always going to have a little bit of a pushback with people, but you learn to kind of approach these conversations in stride because in general, people, when they talk about their money, they become uncomfortable. We don't talk about it a lot in our households growing up. It's not something that people tend to share with other people. So you have to learn how to kind of breach that barrier of getting people comfortable with talking about their money. And once you do that, you can kind of get to the other side of, okay, well, what do you really want today to look like? Do you want to be saving every penny you have, or do you want to kind of live your life where you can have fun now and enjoy the time you have with your family as opposed to waiting till 10, 20 years down the road when who knows what's going to happen, what kind of health event might pop up. If those things are uncertain, you can still be responsible with your money and grow your net worth from now until the next 20 years in a way that allows you to live with more freedom, with more abundance today. I think it's just a mindset shift. And it's also a way of getting around the traditional rules that are set up currently with you put most of your money in a 401k or an IRA, you wait till age 59 and a half. That's so ingrained in our brains that it's hard to rewire that with certain people. So it takes a couple conversations, but once you have those conversations, you get them comfortable talking about money, it becomes easier for them to open up. And usually it's that second conversation you have, maybe a week later, where they've had some time to think about it. They come back and they say, you know what? I've never thought about it this way. Let's talk about that some more. So it just takes a little bit of a shift in mindset to get most people on that track. And once they do, they're excited.
Right. It is just such a paradigm shift and a big realization for people to think, oh, no, I could create an income stream of a few extra $100 a month or a few extra $1,000 a month in addition to my job, kind of like a second income stream.
Absolutely. Yeah. And their eyes light up. And honestly, that's where I see investing for income beat investing for growth.
Right.
Is that when you talk about potentially, investing in assets that can provide some income today to enhance your living standards today, they get more motivated to go into better savings, financial behaviors today, and to keep enhancing that picture. And so the motivation factor, the excitement just escalates. And you take the counter conversation I have with a lot of younger people, I used to have with a lot of younger people about putting away 10 to 15%, saving it over the course of 30 years. You lose them almost immediately because 30 years down the road, I can't even picture what's going to happen in 30 years. But if you can tell them that they can invest for today, they get so much more motivated. That's a great benefit of investing for income over growth.
Maybe a younger client is more likely to believe that that's even a thing, and someone that's been around a couple decades longer thinks it's a farce.
Absolutely. Yeah. It's definitely more the traditional way of thinking.
So it's not like you're dealing with clients that are dumb. I really just think it's a lack of awareness thing. I'm sure you'd agree.
Absolutely. And it is some of these traditional money rules that we've just had in play in society that get ingrained for whatever reason in people's brains. Just think outside the box, think creatively. And these things are doable. It's just that sometimes they've gotten beaten in for so many years that it takes just a conversation or two to really start shaking that dust loose.
Now, how do you do it then? Being a certified financial planner, can you tell them about real estate investments, or do you have some of those same conflicts of interest that you mentioned before?
Well, I had to restructure a bit differently. I was initially set up as a registered investment advisor, and I was planning to manage money for people. But I quickly realized, because I was a real estate investor myself, and most of the clientele that were interested in my services were real estate investors, they didn't want to put any of their money with me to manage. They just wanted to kind of continue what they're doing. And if they did manage their portfolio investments, they wanted to do it on their own as opposed to having me do that. So I wanted to get rid of some of the compliance headaches. And then I saw there's an opportunity for me here to be a coach as opposed to a registered advisor. So now, as opposed to managing money, selling products, and any of that stuff, I can talk in broad scopes about, the portfolio investments and everything they have going on. But I can talk about real estate also and kind of coach them through the process of what it looks like to analyze a property, what that can mean for their financial picture, it just opened up my landscape quite a bit by deregistering as an RIA, keeping my certifications because I'm still talking about planning, still talking about different personal finance topics, but just kind of getting off the regulatory oversight so I can talk about all subjects, but I just don't manage or sell nowadays. So it's a bit different.
We're talking with Brent Sutherland of Intellivest.com. I think he's a breath of fresh air. He's a financial coach that understands both the real estate world and the stock world. And Brent, on this show, so often we talk about creating income for today, but you don't always have to invest in real estate to create income for today. I just think it's the best, most long-term, most proven way to do it. Another way that people can create income for today is invest in dividend-paying stocks. So I want you to talk about dividend-paying stocks. And I think a lot of people don't understand them. Dividend-paying stocks, just in general, and more established companies, a type of company that pays a dividend, because newer startup companies, they're reinvesting their money in things like research and development, and they're not paying it out in dividends so much. The average dividend-paying stock of the S&P 500, I know that pays somewhere around 2%, and it's been that way for a while. But depending on what sector you get into, for example, the materials sector, their dividend-paying stocks might pay an average of something like 4%. So tell us about the perspective of dividend-paying stocks.
I think that's a great route to go for someone who might not want to get into real estate, but they have an interest in investing for income. But there are a lot of different companies in the stock market that will, and like you said, they're more mature companies usually. So they've already established themselves. They have a nice track record of earnings. And so as opposed to just putting all their money back into the company and really trying to grow, they usually already have quite a large moat by this point. So they're not interested in growth. So as opposed to just hoarding all the cash, they want to attract more investors. So they decide to pay out a portion of their earnings in the form of dividends to their investors. And as you said, this might not be, an astounding figure. On average, the S&P pays out about 2%. But if you do get into the utility sector, the material sector, and there's real estate investment trusts that are within the stock market as well, they can pay out upwards of 4, 5, 6%. And that can be kind of a nice middle ground between just investing for growth. And if you don't want to dip your toe into the real estate sector personally and hands-on, you can invest in stocks that do pay dividends. And it's a nice kind of middle ground there.
Is there a lack of awareness among dividend-paying stock investors that their dividend is often just being reinvested back into the fund and they could instead take that dividend as a distribution today?
I think so. I mean, that's something that you have to make a decision on when you invest in a fund. Most companies will give you the option up front to get that dividend paid out to you in the form of cash or to have it reinvested. A lot of companies, what they'll do is they'll automatically enroll you into reinvestments into the fund. So people never see that hit their cash account. And so they're not really aware of what they're getting paid in the form of dividends. But I would strongly suggest that everyone have that set up to pay in cash. And that way it gives you the option to either one, take that money out, pay yourself, or two, if you do build up a little chunk of cash, you can reinvest that into whatever you see fit. But it gives you the option, it gives you control as opposed to just putting it back into the fund management company's hands to reinvest into their product.
Exactly. That's just something in my own experience I've seen a lot of people not have much awareness of, or none at all, frankly.
That's very true.
Now, you don't just talk the talk, you walk the walk. You invest in real estate directly for cash flow yourself. Tell us about that.
That's kind of my bread and butter. I wanted to get into real estate just to develop some additional income streams, diversify my income streams. I think that's an important form of security you can have, is diversifying all the sources of income you have in your life. But currently I have 9 standalone properties. And then I also in a partner deal with 2 other gentlemen, and we're investing in a commercial real estate project. My goal is to get back into the buy and hold properties. So once we turn this property over and make some money, I'm going to reinvest all those proceeds back into additional properties that I can just keep for the long term. They'll pay me out over the course of time. And this could hopefully be something that will continue to improve my life. And then I can pass along to, my heirs down the road and just make this more of a generational wealth type building, network building project.
So the 9 properties that you currently have, are they cash flowing residential properties?
They are. And currently I'm getting probably around $250 a month free and clear after all expenses per property. After turning this other property over, I hope to invest in an additional 8 to 10 doors. So at that point, I hope to be up closer to 18 to 20 properties over the course of 2020.
That would be a nice pack of properties there. That's a really good goal. So we talked about some of the oversights that traditional stock and mutual fund investors might make. What about some of the financial planning oversights that you see with real estate investors? What are some of the more common mistakes made?
Well, this one's an interesting one because I do work with a lot of people who want to get involved into real estate. So we're going through what that might look like, what their approaches should be. But I also work with people who are very experienced with real estate and more advanced than I am with their books and what they're looking to get into. So my job in those situations is to kind of look at the full picture and see if there's some areas that they're missing, point out the blind spots. One common area I see people overlook when it comes to the full financial picture they have for their household is in the form of a little bit of neglect on the estate planning side and then in their financial protections. And I'll dig in a little bit more. What I mean on the estate planning side is not necessarily that they don't have their documents in order, their will and some other documents in place. It's that they're not really protecting their family as much as they probably should. And I think most real estate investors will understand when I say that when you get involved in real estate, you get excited about it. Pretty much every dollar you have extra on top of your savings, you want to put back into future projects. Right. So there's not a lot of cash that people have in excess on the sidelines because you want to put this money to work. What happens in that situation, if something were to happen to that person, then the family is left with a lot of fairly illiquid holdings. So you need to have something there to help the family get through that hard time and deal with the estate, deal with the day-to-day living expenses. There will be some cash flow coming in from the properties, hopefully to cover some of that. But it's nice to have, if you don't have just a life insurance policy in place, to have enough cash reserves to help the family, especially if you have some dependents or, a spouse that really relies on you, to have something liquid there to make life easier for them and not leave them in a bind. And on that same note, oftentimes there's one person who's really tackling the real estate projects. If they were to pass away and then this was left behind, their book was left behind for someone else to handle, they might not know where the properties are. They might not know who to contact to get information about the property. So having a detailed list of all your holdings and all the different contacts that are associated with those holdings is paramount. Make sure you leave that behind so someone else is not struggling to try to pick up all these pieces.
Right. Does your spouse even know what states you own properties in? I sure hope so, and that they know more than that. And this is something else that Brent helps people with. And Brent, when it comes to financial planning oversights with real estate investors, I want to know what you think. One thing I see happening is people going overboard with LLCs, limited liability companies, and some people wanting to slow down their real estate investing until they think they know everything about LLCs. And LLCs are probably the right entity for holding your real estate in when you do want some more protection. But when I say that I see people go overboard, first of all, I think people need to remember that LLCs are not your first line of protection. Your first line of protection is being a good operator and having good operators on your team. Sort of think of the second line of protection is having low equity positions in your property so that there is no low hanging fruit for potential litigant to go after. Thirdly, landlord's insurance kicks in. You might also have umbrella insurance in the mix. So in LLC, there are just so many more protections that come in before that. And once you have an LLC, well, I'm not saying they aren't worth doing, but just understand that now you have formal documents and corporate formation and articles of incorporation, and you have some maintenance things to do with this. And we've had Rich Estate Advisor Garrett Sutton on the show 3 times, and I think he brings a little bit better perspective to the whole LLC issue than some people do. For example, he doesn't say you always need an LLC for every single property and so on, but I just want to know what your perspective is, because I see people get overly concerned sometimes about LLCs.
Oh, absolutely. That's a big one. And let me first say this. Everything mentioned here obviously is not personal financial or legal advice. It's basically just 2 guys talking and expressing their opinions here. So I need to make sure I tell everyone to see their advisor, accountant, or attorney before going into anything personally. But I see this as a big issue, is that people just get caught up in analysis paralysis and they think that they need the LLC before they buy the property. And there's so many issues that can come up from doing that. It can cost them a lot of money to get that established and to then try to purchase within that it causes such a hurdle they never get started. And there's so many protections, as you laid out, that are kind of already in place. Yeah. And then another one on top of that is if you do have a property manager, make sure you ask that property manager to get a copy of their insurance as well, because they're going to have some form of liability protection for themselves. That's almost another barrier between you and then a potential lawsuit on the property is that your manager is there, and potentially they could be in the middle of something that were to happen. So in addition to everything you said, you have your property manager. There's so many different little barriers that can be in the middle of that to protect you, that an LLC is probably not the first thing you need to be worried about. I think getting started, finding the right deals, learning how to evaluate properties, and making sure you're buying smartly should be your first and primary concern. And then as long as you get your insurance set up, as long as you have some lending on the property, you don't have too much equity at stake, and everything else you mentioned, there's so many other protections in place automatically that are kind of there existing that you don't need to worry about that LLC right away. Maybe down the road, you can start moving some of these properties in once your equity position is built. That might make more sense. But initially, that's a big hurdle that people put in front of themselves that they don't need to.
Yeah, I'm not saying LLCs are always unimportant. I'm saying, my goodness, some people need to be sure that they would even have enough assets for a litigant to want to go after for a suit to even come up at all. And lawsuits are actually pretty rare in this space.
You're exactly right. Very small chance of getting sued in this area.
Brent, before you tell our audience how they can learn more about you, is there any last thing about this entire certified financial planner space that you've moved away from, where you've gotten more into real estate investing and being more of a holistic financial coach? Anything perhaps I should have asked you but didn't?
No, I think we've covered a lot here today. I mean, there's obviously different topics we could dig into, but I think that what's interesting nowadays is that there is a growing, I think, demand for people that are kind of outside the traditional norms. And this is kind of why I moved outside the traditional financial planning arena into more the coaching space, is that I wanted to talk to people about real estate. And I'm seeing a lot of younger advisors moving away into the coaching space because they want to talk about helping people start businesses. It's a little different than just having them put their money into traditional investment assets, such as mutual funds and stocks and bonds. They want to talk about other topics, which a lot of younger people nowadays are interested in. So I like the fact that I'm seeing a growing trend towards people tackling different subjects as areas of expertise. And they're kind of moving into this financial coaching space that's growing in all different areas and niches that I think are going to benefit a lot of people. And I see a few advisors that I've been in communication with tackling this real estate subject that hasn't really been tackled before. So I'm excited about that. I hope there's going to be continued growth in this area because there just needs to be guidance for people and alternative ways to put their money to work as opposed to just putting it into traditional retirement accounts, traditional investment accounts that, like we mentioned before, can be effective, but they can also be a slow churn. So we need to talk about some of these other ways to increase the velocity of your net worth growth.
I know a lot of CFPs that do listen to this show, and I've talked to them face to face, and they say this show has been quite an eye-opener for them. So how great that you had basically that restriction removed on you so that you are no longer tongue-tied like you had been.
Absolutely. And honestly, Keith, it shows like this that I think are going to continue to inspire way more people to branch out and provide services that are needed. So appreciate what you're doing because I listen, and it's been inspirational for me as well.
Well, you're a financial coach. Tell us more about what you can do and how our audience can learn more about you, Brent.
Well, yeah, I just basically, I help people, like I said before, to take a look at the full financial picture, point out, some areas that they might be missing or there might be some issues. And then I try to also predominantly point out opportunities for them to really enhance their life, not just down the road, but also today. You can find me at Intellivest. It's just Intellivest.com. On that website, I have my information there. If anyone wants to reach out, you don't have to book a call. I'm always available through email if they have questions about anything. I try to put some information there that's valuable for people and some resources. So feel free to check that out. And if you have any questions, feel free to reach out to me directly.
Brent Sutherland, I love chatting with you. It's been great having you back on the show.
Keith, thank you again for having me. I appreciate this.
Doesn't Brent just sound like a guy you'd want to talk to? Brent Sutherland is one of my favorite CFPs anywhere. Now, a good company doesn't necessarily make a good stock. That's an entire discussion unto itself, and I don't own any stocks, not through a fund or in any other way. I think, bottom line, so much of this begins with your mindset. Many people think that you must make some terrific sacrifices now in the mere hope of living how you want to live decades down the road. A lot of this, real estate versus stocks, income producing or not, it comes down really to your own internal confidence, that feeling that you have about yourself and your future and what you think your own potential is and what you think your willingness to learn and earn throughout your life is going to be, and you're almost always capable of more than you think. It becomes personal for you, and well, that's why this is called personal finance after all. I often like to leave you with something actionable at the end of the show. If you're looking for some coaching on your personal situation where you can get some unbiased guidance absent of all conflicts of interest, you can learn more about Brent at Intellivest.com. That's Intellivest.com. You are listening to the last show of the year, but don't worry, it's also the last week of the year. I'll be back next year, which is next week, to help you build your wealth. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.